Hello and welcome to episode 290 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leakes. Damien, how are you doing? We're in the new studio today.
That's what I was about to say. You sort of stole my thunder, but yeah, we're recording this week's show in a new studio, part of our office. So Money to the Masses has been expanding, as I've mentioned. So we've acquired another office next door to the two that we already have, and we've turned it into a studio. You'll see some of the video that we've been putting out on our social channels, particularly YouTube, and you'll see more and more of that now. And also, I'm quite excited about the prospect of another new member of the team next week that's joining us on Wednesday. Her name is Laura, and she'll be writing about consumer credit. So talking about credit cards, mortgages, and a whole load of other things as well. So she's a very talented individual. So we're pleased to be having her coming on board with Money to the Masses. So the team is growing and continuing to do so. So we are still recruiting out there. So it's exciting times for Money to the Masses, and it's exciting to be in the new studio.
Yeah, it's nice to brighten us up on what is a horribly wet and windy day and weekend. So when people are listening to this, no doubt the weather's going to be no better either. So this will brighten you up.
Yeah, do spare a thought for me though, because I will be standing on the touchline of a football match watching my daughter play one of two football matches this weekend. I will be completely soaked probably in the far east of Kent, so pretty much as far as you can go before you fall off the cliff. So
yeah, that's a particularly windy and wet part of the Kent coast. There's a reason why they put a lot of wind turbines and things out on that side of the coast. Right. Okay, so let's just move on to the podcast this week then. What have we got coming up on this week's show?
So this week I'm doing two investment pieces on this show. I'm going to do a piece about rebalancing. It's something that we throw the word around about rebalancing your portfolio, but I wanted to talk a little bit more about it because there is some nuance to rebalancing. And I know there are a lot of people out there that have investment portfolios that start off with particular asset allocations and then they can then veer off. And I wanted to give some insight into the best ways to do that and some tips. And the second piece, which is a media piece, is about ethical investing. Now, this week I did a research article for 80/20 investor members and focused on ethical funds and in particular how they've been performing versus their non-ethical peers in the last few years, but in particular during the COVID pandemic. So something very interesting there that you will want to listen to. And the third piece, Andy, which I think we're going to start with this week, is a piece that you're going to be doing.
Yeah, let's start with the first piece and get straight into it, really. So what we're covering is cashback apps. Now, you may not have heard of them, you may be an expert at them, but we're just going to cover off 5 of the best cashback apps and what they do and why you should download them. And actually, a real good tip on stacking the cashback apps to maximize your cashback. So, what is a cashback app? Do you know what a cashback app is? No doubt you do. Do you use them?
I don't use them. Well, actually, I'm going to veer slightly off topic because in previous episodes, I've been banging on about I've been going down the cashback route. I got a new broadband provider. Well, I had one of those falling down moments this week because I'm still fighting to get that particular cashback back. And my broadband has been down for 3 days. I'm having to get an engineer out to fix it. So I'm firmly in the grumpy camp when it comes to cashback at the moment. But
right.
Anyway, that's not a very good advert. It's just probably down to me. But Andy, cashback app.
So a cashback app is an app that you can download to your phone and you can maximize your savings by getting cash back on your purchases. Now, the idea of a cashback app is that you don't go off and buy things that you wouldn't normally buy. They should live in the background and help you to actually maximize your savings, streamline your spending so that you actually save money on what you would normally purchase. Does that kind of make sense?
That makes sense. You're not going to take advantage of offers just to get cash back because that's counterintuitive.
It is tempting. So we'll cover off the first one. One of the most popular cashback apps out there is one called Top Cashback. There's another similar one called Quidco, but for this yeah, okay. For the purposes of this piece, we'll talk about Top Cashback. So Top Cashback is an app that you can sign up to on your phone. And essentially, if you want to buy something, anything, you would go on to Top Cashback first of all. You would open the app and see if that retailer is on there listed and is offering a special offer of cashback. So you might, for example, decide you want a new Hoover or a TV. Rather than going to, I don't know, Curry's PC World, you would open up Top Cashback as an app. You would search for what you want. And there may well be a deal on there, 2%, 5%, 10% cashback if you purchase through the app.
And it could be like a broad deal, not just that Hoover. It could be electrical devices or something like that.
It might say that Curry's PC World is offering 5% cash back for all people up until the end of the week.
So you click through, complete your purchase just like you would have done, but you're going to start earning cash back within that app.
Yeah, so the app itself will log the cash back. You'll generally get an email, and in your account there'll be a little alert that says we've tracked your cash back, so you know that something is happening. The only downside to Top Cashback and Quidco and all of these types of cashback apps is they take a while. So it will say that it's been tracked, but it might take anywhere between 3 and 12 months for your cashback to arrive in your account. But, it's money for nothing for a lot of these things. Because there's so many retailers, there are so many people who use these cashback sites, Quidco, Top Cashback, that you can easily build up £10 to £50 a month if you want to.
You're a bit of a cashback ninja with these guys, aren't you? 'Cause I know you've shown me on your screen. You were the person who got me into the idea of using cashback. I'm not saying I blame you for my current predicament, but I see the merits of it, because when you've shown me, I think it's brilliant. I'm trying to make sure I do it more and more, because it is, as you say, money for nothing, really.
Yeah, so that's one we've covered there, Top Cashback. You download it, anything you want to purchase, check the app first. If it's on there, purchase through there, and over time, you'll start to build up cashback. If you used it for every purchase, you'd probably find, 1 in 10 of the things you want to buy is probably on there. And over the year, you might save, on average, £10 a month, about £100 a year on average. Another similar app is called Airtime Rewards. So it's AIRTIME, Airtime Rewards. That's available on all smartphones. So whether you're on Android or iPhone, just search for that. This cashback app works on your phone number. So it will link to your phone number. And when you sign up, you'll need to tell the app who your mobile phone provider is, because this cashback app will actually give you cashback in the form of credits on your mobile phone bill. So it's an interesting concept, but crucially, it's far less effort, this one, because you don't actually have to search for the deals yourself. So if you download Airtime Rewards, you pop in your phone number, you tell it which mobile phone provider you use. Every time you use your MasterCard or your Visa card, if that retailer is supported, you'll earn cashback automatically. Now, the amount of cashback you'll earn depends on the retailer, but it's generally between 1% and 5%. But the crucial thing is here, you don't need to do anything. You set it off and it does its thing.
See, I like that. I mean, I've never heard of it, but the problem with the first two, Quidco and Top Cashback that you mentioned, is a kind of, I've got to stop what I'm doing and go and use the sites or the services to be able to try and accrue that cashback. And I'm the sort of person who wouldn't do that. How does that work if you've got a pay monthly contract, though? So you're paying a certain amount a month for a set number of minutes, etc. How does the cashback work on that?
Yes, so it works for most phone providers, even the smaller ones, and you'll earn it in the form of credit. So once you tell it which provider you're with, even if you're on a pay monthly or a pay-as-you-go contract, you'll earn a credit and you'll accrue that credit. And for example, Jordan, who wrote this article, he's got a SIM-only contract and it's only £8 a month because he's a money saver, and he actually gains enough cash back to pay for his bill every other month.
We forgot to mention that at the beginning, actually. This piece, if you want to find out more about what Andy's talking about, go on the website. There's an article written by Jordan Cox, who is effectively our resident money-saving guru. He does a lot for us. He writes for us. He appeared at our event last year, and his article inspired this piece. You can find out more information. So Jordan, doesn't surprise me that he's not paying anything for his mobile phone bill by saving cashback.
Yeah, and I just to finish off that piece, if you're looking at how much you could potentially save, I mean, it depends how many retailers are on there, but it's a little bit less than Quidco and Top Cashback. We'd be looking at around about £5 a month, maybe 60 quid a year, there or thereabouts. But again, crucially, you're literally downloading an app and letting it do its thing. So it's pretty much money for nothing.
It's the lazy way. I like the lazy way.
Zip Zero is the next one. We'll cover this one off very quickly. Zip Zero is an app that requires you to scan in your receipts. Now, where this is really clever and really cool is it doesn't matter what receipt you scan in, it will accept it. So long as the receipt is dated within 7 days, then it will accept that receipt and you'll earn 0.5% cashback on everything you scan in. So if you buy, if you buy £1,000 new fridge freezer from PC World, you get that receipt, you scan it in, you get your 0.5%.
So if I go to Tesco and I go sort of shoulder deep in the bin and pull out all the receipts and scan them, then I'm going to be getting cash back on everything.
Only if they're within the last 7 days.
I don't know. They don't change their bins that often. That's pretty good. So that, again, how do you get that cash back?
So once you've earned a minimum of £5 in cash back, you can basically claim that cash back against one of your bills. So it's similar to the last one where we talked about airtime rewards and that gets you money off your mobile phone bill. This one will give you cash back where you can claim it against one of your other bills. So it could be your council tax, it could be your electricity or gas.
I like it. Nice idea. Next one.
So this is one I've actually tried and continue to try, although in lockdown not so much. It's called Shopmium. Shopmium. Now, this is a pretty cool app. It will basically alert you to free offers and coupons and cashback. I say coupons, it's a digital coupon where there's offers in a certain supermarket. So in order to get these deals, you need to be at the supermarket. You can't do it on your online shop. And the way it works is it will highlight a certain offer. You can sort it by different grocery retailers. So for example, if you're going to Sainsbury's that week, you would open the app, you'd click on Sainsbury's, and there'd be maybe 5 offers displayed. And it would say, do you want to buy this beer? And it's £2.50 off. Do you want to buy this ice cream? And it's £1 off. Do you want to buy this product? You can try it for free. So you can actually get free products as well. So the way that it works is you have to pay for that product up front. You will then get the receipt. You'll go into the app, you'll scan the receipt, and you'll get the cash back on the receipt as paid as a credit into your account. So keep it really simple. Let's say you see some beer on offer. It's £5 in the shop. They're saying on the app that it's £2.50 off. You pay the £5, then you get your £2.50 credit into your shop account.
Yeah, clever.
Brilliant thing about that is it's payable within literally 24, 48 hours, and they will pay it into your bank account or PayPal account. So I've had a situation where on a Friday, I've gone and bought some non-alcoholic beer, and it's literally been in my bank account on the Sunday or Monday. So it's pretty good.
Okay, like that.
The last one is Green Gin. I'll spell it out because it's a strange name. It's Green, Green, and Gin. Ginn. This is a cashback app similar to Shopmium. You need to go into the shop to get these cashback offers, and it's offers on healthy food only. So one day it might be, I don't know, grab some apples and you can get 50p off, or it might be mushrooms or kale or
organic beer.
Not so sure. So it works in almost identical way as the last one we talked about, Shopmium, but it's more focused on healthy products. So if you're a bit of a gym buddy, someone who buys a lot of healthy foods, this is going to help you save some money. You may even try some new fruits, new vegetables as a result of it, and you'll maybe get, I don't know, £2 or £3 a month if you're doing it often, maybe worth.
I tell you what, I like those. I mean, there's some, despite my unfortunate sort of first dabble with cashback, I think there's a couple on there that are actually worth looking at, especially the ones where you don't have to do too much, and it's a buy and forget kind of service a little bit more. I like that. That appeals to my nature.
You say that, just briefly going back to that airtime rewards one, which we liked, which is the one that you set it off and it does its thing. I did find that it didn't really work for me. I do a lot of my spending on my Amex card, which I earn cash back on anyway. And of course, I downloaded the app, put in my mobile phone provider, and then it just went, we don't deal with Amex.
But of course, Amex has cash back on it anyway.
So
you're stacking. This goes back to the point you said at the beginning. You could stack by, let me get this straight, you could theoretically use a cashback app, a cashback credit card, and probably use multiple of these cashback apps at the same time and be drowning in cashback. Am I right?
Yeah, absolutely right. Jordan gives a really good example in the article. He gives an example of Topshop. Topshop were offering multiple cashback offers on the various different apps. So if you spent £50 in Topshop, for example, you would get 8% cashback via Top Cashback straight away. Airtime rewards are also offering 5% cashback. So if you got that app, you'll get the 8% plus the 5%, which is 13%, obviously. If you then click and collect and pick it up in store and you get an actual physical receipt, you can scan that receipt and get 0.5% on the Zip Zero app, and so your quid's in. You'll get 13.5% back. You spent 50, you get £6.75 back, and you've done, well, okay, you've had to click and collect, but pretty good.
That is pretty good. So that's why Jordan was the coupon kid. I can see why. Well, he's a legend at doing this. So great. Okay, are we done on cashback?
Cashback is done. Not for you. You're still arguing your cashback, but that's one for another day. What are we going on to next?
Okay, as I said, I did a research piece for 80/20 investor members this week, and it came about because in my own 50k portfolio, which I run live on the 80/20 investor site, 2 of the funds I hold are actually ethical funds. And that's not because I'm trying to be ethical in terms of my morality and money, but because of the returns that they provide. And having done lots of analysis on the impact of the pandemic on investment markets and particular funds over the last few weeks in particular, it led me to notice a trend relating to ethical funds and their performance, particularly in the last year. So what I wanted to do was revisit the idea of ethical funds, but in the context of the backdrop we are at the moment. And so what I did is I looked at the 127 unit trust funds that are either ethical or sustainable. And now it's often hard to find these funds. They don't exist in one sector. They exist across every sector. So UK all companies, global equities, you name it. Most sectors have at least one, but the majority are bunched into about 3 sectors. So that's UK all companies has 22, the mixed 40 to 85% shares sector has 14, and the global sector has 34. So what I wanted to do was look at those funds and see how they'd performed over time, particularly in this last year, versus their non-ethical peers. And so I crunched the numbers on these funds. And so, like I said, there's 127 unit trusts. I didn't look at the ETFs. So if you want to look at the ETFs, there's about another 250 of those. But over the years, the number of ethical funds is increasing. Go back 10 years, it's half of what it is today. It's around about 66. Now it's about 127 funds, as I mentioned. So I crunched the numbers to see how ethical funds had done. And if you want to see the full research piece and the numbers, obviously you can subscribe to 80/20 Investor for a free trial. But what became apparent is that ethical funds have been outperforming their non-ethical peers. If you look at the performance year to date, the 1 year performance, the 2 year performance, 3, 4, 5, and 10 year, the cumulative performance numbers. So the funds that I hold in my portfolio are not outliers. There's obviously something of a trend going on here. So I dug a little bit deeper into what could be driving that. And I've touched upon ethical funds in the past. And one of the things I pointed out is that they tend to be overweight in technology-based companies, so tech stocks. And they also tend to be overweight in financials often, but they also tend to have a smaller companies bias. Now, bear that in mind, what I've just said. Now, if you look at what's happened year to date, if you were to go and rank all of the equity sectors within the UK, so if you took all the shares in the UK, bunched them into their sectors and looked at the performance, there is a real disparity. So, for example, oil and gas companies as a collective are down about 26.6% year to date. If you go to the other end of the spectrum, there's some technology stocks as a group that are up 37.5%. If you looked at things like healthcare, they are also positive for the year. Now, ethical funds by their very nature tend to avoid or be underweight. So that means they carry less exposure to oil and gas companies than, say, the FTSE 100. The FTSE 100 has a significant exposure. In fact, it's one of the biggest sectors in the FTSE 100, which is why when you look at the numbers, the FTSE 100 is still down around 18 to 20% year to date. And the reason why oil and gas have done badly is because of the coronavirus. So if the coronavirus came along, the global economy stalled. If the global economy stalls, then there's a drop in demand for oil in terms of transportation, in terms of manufacturing, and the oil price collapsed. And if you remember, at one point this year, the oil price actually turned negative. So any company that has exposure to that, so we're talking about BP or Shell, their share prices therefore took a hammering and have done this year so far. So the impact of the coronavirus meant that the FTSE 100 is underperforming because of sectors like oil and gas doing badly. Also airline stocks have done badly because air travel has basically ground to a halt when no one's going on holiday. So taking that to the ethical world, where they are underweight compared to, say, the FTSE 100 oil and gas stocks, therefore they've not had so much of a negative drag on a typical ethical fund that, say, invests in the UK all company sector. So it's had less of an impact on ethical funds from, say, the UK all company sector. Equally, there are plenty of ethical funds. Now, their mandates are all very different, but plenty of them will avoid airlines because airlines are polluting by nature. The other thing is, while they've actually avoided certain sectors or been underweight them, they've been overweight others. Now, yes, I said financials. Financials haven't done that well year to date because when you cut interest rates to try and boost the economy, that hits the profitability of banks. Now, we've not had a banking crisis this time around, but it's still hit the profitability of banks, and it's also meant that defaults on loans are likely to go up. So bank shares and financials have lagged somewhat, but ethical funds have enough bias to some of the other positive themes to outweigh that. And yes, they are still down if you looked at the ethical funds for the year to date if they were invested in UK equities in particular, but less so than their non-ethical peers. Now, to give you an example of a positive, I mentioned the technology exposure, but healthcare. Now, if you go and find an ethical fund, go and find one. You could go and Google one that's in the UK all companies space. I could almost bet you that the first 2 or 3 largest allocations to any company will be to a pharmaceutical company. And by that, I mean AstraZeneca or GlaxoSmithKline. Now, A couple of weeks ago, I did a piece called Investment Funds for a Vaccine for 80/20 investor members. I didn't do it on the pod or mention anything on the podcast about it, but I looked at funds that could benefit from a vaccine being found. And they were funds that had exposure to the likes of AstraZeneca or GlaxoSmithKline, companies that are trying to make a vaccine, because if they hit the jackpot, their share prices will go up. And many of them, their share prices have been going up. AstraZeneca, for example, share price is up 11% year to date. Compare that to what I was saying with some of the other sectors, that's quite a big difference. Now, ethical funds tend to have exposure to these sectors, or more so than the wider indices or their non-ethical peers. And so that's helped push up, once again, their returns. So the message is that ethical funds have been doing very well over the last year. I'm not going to give you the individual numbers of ethical as a group versus non-ethical for each sector. I'll break it down and you can see which sectors in the research piece I did for 80/20 Investor where ethical funds are doing very well compared to their non-ethical peers. But what it shows you is that there are biases that exist within ethical investing by its very nature, that when the investment backdrop favors them, they will outperform. And in this instance, coronavirus has, by sort of quirk of fate, been one of those scenarios. So we're in a position where ethical funds have got a tailwind behind them. And on top of that, if you looked at any news stories about government fiscal measures and stimulus around the world, a lot of it has got a bit of a green agenda. They're wanting the recovery to be a green one. So they're investing in things that are going to be positive from an environmental perspective, which again plays into that whole ethical theme, which a lot of these funds tap into. Also, some of the multi-asset ethical funds invest in assets such as gold. So something a little bit different that a lot of funds don't, because gold in itself is pretty inert in terms of its nature, but I suppose in terms of ethics it is too. And gold has been in a bull market for quite a while now. So that's been a positive from a performance perspective. So what I wanted to say was the message from this part of the podcast is that in the past people have said, does investing ethically mean you are going to lose out in terms of performance because your scope, your universe of possible investments is smaller by definition? It's a subset of the full wider universe. And the answer has always been, well, no, it doesn't have to necessarily mean that. Whereas at the moment, what we've got, the message has changed a little bit, because it doesn't have to be if the environment's working in the favour of the natural biases that exist in a lot of ethical funds because of their mandate. We're actually at the point where actively choosing ethical funds is starting to make a bit of sense, almost from a defensive perspective as well for your portfolio. So it's a slight shift because we are in that environment. When the environment changes, the fortunes will change for ethical funds. But it's just an interesting piece for people. If you drill down, look at what's going on, it isn't just ethical funds are much better. Ethical funds just have biases that the current environment is benefiting. And as I mentioned at the very front of this piece, it isn't easy to find ethical funds other than when they have a label. So some of them that are called something ethical, that's kind of obvious, but some are positive from a sustainability perspective. So you can screen for those using sites like Morningstar or TrustNet. They do allow you to screen across sectors so you can find them. So like I say, there are unit trusts and there are ETFs. So go and have a look at them, dig down into which sectors that they're investing in, and then you'll probably understand why they are either outperforming or lagging, and when the reverse will also be true. But as I say, it's all broken down sector by sector. I even pick out the top performing ethical funds in that research piece on 80/20 Investor if you're interested.
Okay, continuing on the investing theme, you're going to do a piece on rebalancing, what it is and why you would do it.
Yeah, so if you go back to podcast 183, now
I remember it well.
I could test you because there was an outtake at the end of that one, because I listened to it the other day. I mean, I do listen back to the podcast, and every episode that goes out now, I do listen to the full show before it's released, but I do go back and listen to odd ones, not like in a weird way in the bath or anything. It's when I'm doing research for pieces that I've done, so we don't cover old ground. But in that piece on the podcast 183, I touched upon rebalancing, and it was part of a sort of a wider investment piece, but I wanted to focus on it because there was a couple of things that I think I could expand upon, and it's in light of some of the work I've been doing recently around rebalancing portfolios. And one or two things I don't think people really realise. It will seem obvious once I explain it, but I don't think for some people it will necessarily be obvious. Now, rebalancing is where you have a portfolio. So let's keep it simple. Let's just say you have 60% of a portfolio portfolio in equities and 40% in bonds. Now, as investment markets move up and down, then let's say equity markets rally strongly and bond markets do the opposite, then your 60% equity will start to grow in size and the bond portion will start to fall in value. When you look at the monetary amounts of your portfolio and then work out the allocation, say in a year's time, then it won't be 60-40, it could be something like 70-30. I'm using slightly extreme examples, but what that means is the risk is rising in your portfolio. So you've got more exposure to equities, it's going to be more volatile. If a stock market crash comes along, you're going to be more exposed to it.
Do you know what? Now you mention that and say it and explain it in that way, it makes perfect sense, but I'd never considered that if you just leave things as they were and you set it at 60-40 in whatever, however many, because one's rising and one's falling, you wouldn't actually still have 60-40 in 5-10 years' time. I hadn't even considered.
I tell you what it's like, is when you drive on a motorway and you're driving along, you're going a long distance, and you don't realise unless you look at your speed or you see the sign every now and then, because motorways don't have 70 mile an hour all the time, your speed slowly starts to creep up and you don't even realise it, and you look and you think, blimey, I didn't realise I was doing 80 while I was over. Because if everybody's moving at that speed, the risks are rising, but you don't notice them. And so that's why re-evaluating the speed you're driving at, or put it in a cruise control, something that's going to reevaluate that and put it back into line, that's what rebalancing is. So you might want to, in that example, rebalance after a year and bring your allocation back to a 60-40 split. And there are a lot of people out there who will have fixed allocations that they're investing in, whether it's, I've used a very generic 60-40 there, but we could go into the individual equity sectors. So you could say UK equity, North American equity, and break it down even further. We could also do that on the bond side. Now, most people tend to have a fixed allocation that they will try and stick to. And so this is a reminder that you might need to review it every now and then. Now, how do you bring it back in line? Then the answer would be, in that scenario, you would sell down some of your equity holdings and then you would rebuy some of your bond holdings. And what that does is it actually enables you to sell high and then buy low, because the bonds have fallen, the equities have risen. And it's the secret to being good at investing is you don't want to be buying high and selling low, which is what most people do, because emotionally when the market tumbles, they all start panicking. And when it's at its lows, they all keep selling. It's actually causing you to sell high and buy low. And so you're reinvesting profits into an undervalued asset, which if you invest for the long term should have its day. Every dog has its day. And then when that particular asset then starts to rally because equity markets say fall and bonds start to pick up, you've reallocated profits into the bonds, which are now going to benefit from that. And then you'll make more money out in the long run. That's the theory, and it works out in practice if you look at it. But of course, it isn't just about equities going into bonds. There have been rare occasions where it's gone the other way. If you go back to the financial crisis that happened, bonds really outperformed, equity markets bombed. But then what you would have done is sold out of some of your bond holdings, and then you would have bought some of your equity holdings, because rather than that 60-40 split we talked about in my general example, maybe it had gone more like 40 equity, 60 bond because of the way the markets moved. That would have felt really unnerving, because at a time of equity market stress and they were falling, you would have sold out of your safe assets that have been doing well and buying equities when they were down the bottom. But
again, of course, you're buying in low, aren't you?
That's the point in the long run. So you're buying an undervalued asset. So it's rare that it happens, but that's why rebalancing is logical anyway and is a good practice. Now, I did some research for 80/20 investor members when that podcast was made, and I looked at different time periods and the impact if you rebalance monthly, quarterly, 6 monthly, annually, and what impact it had on the risk management of a portfolio. I don't want to give that all away, but typically, if you want to know how often you should rebalance, annually is enough. It is enough, and to be honest, if you're more and more you go and rebalance, sometimes it can be a hindrance because you're sort of pruning too much. Yeah. But of course, that is assuming you want to use a time frame as a trigger to rebalance, because there are other methods. There's another method where you decide to rebalance whenever your allocations move by a certain percentage, so they stray. And that straying maybe, let's say, 5 or 10%. So you have a threshold. Going back to my example, keeping it simple, just a 60% equity exposure, 40% bond. Let's say the equity exposure had crept up to 65% and the bond exposure dropped to 35%. That 5% move could be enough to say, yeah, actually, I need to rebalance. Or if it'd been 10%. So you could decide what leeway you want when you're deciding to rebalance. That's another method. A third method is to use a combination of the two. So you might look to rebalance annually, but if the tolerance levels of your allocation haven't been stretched or breached, so maybe the equity component is only up to say 62%, then you'd be like, no, I'll leave it, it's fine. So there are different ways to do it. The other thing you need to do is, rather than just look at that 60-40, that's a very easy example I've picked just for the podcast. It's easy to visualize. The other thing is you need to drill down into the individual funds that you have. So it's unlikely people just have one equity fund and one bond fund. That would be inadvisable. They'll have a range of them, and they may have some that are multi-asset funds. So what you need to do is you need to drill down into what each fund holds. And those allocations can change. So you can't just assume that looking at a fund name that fund invests in a mixture of bonds of equities at this particular percentage. That could change over time. The manager could change the underlying investments. So you do need to make sure you reanalyze properly what's going on in each fund. And what we will notice, on 80/20 Investor, we have a tool that does this. And so you can put in any portfolio and it works out the allocations by drilling down exactly what each fund invests in. And nearly every time people use it, they always say, I'm amazed at my allocation. I didn't realize I was actually 80% exposed to equities. And they are like maybe say 60 years old, and then they suddenly realize that. Now, some investment platforms, if you hold your funds with one particular investment platform, should be able to help you with that allocation and be able to x-ray the individual funds. Of course, if you hold them in different places, like different platforms, that necessarily won't be possible, but do try and x-ray them once a year at least. It's worth the time, because then you can reallocate and reduce your risk, or in fact increase your risk if you want to. So that's one of the most important things about rebalancing. But there's one final thing that I wanted people to think about when it comes to rebalancing. We always hear rebalancing spoken about, right? You sell down this fund and you buy this one, or you sell down this particular equity and you buy this particular bond, whatever it is, and you move money around. There is another way to do it, and that is to add money to the underperforming fund or asset. So rather than selling down if you got to the 65% equity and the 35% bond allocation, you could add more money to your bond allocation till it got back to 60-40. And there are two reasons why I quite like that approach. And I know if you haven't got the money to invest, then you can't do this. But firstly, it encourages you to keep adding money and building money into your portfolio to help it grow. And that's obviously, as well as the return you get on your money, the more money you put in, the more likely your pot is going to be bigger when you get to retirement or whether, because of the power of compounding. So from that perspective, it is preferable, because you're putting money to work and you're actively buying things that are undervalued. The other thing is that if your investments are held outside of a stocks and shares ISA or a pension, when you sell down an asset, you create a tax event. So you could be liable to capital gains tax, for example. And so if you have got your investments that aren't inside an ISA or a pension, then by selling down and rebalancing, you've created a tax liability potentially, which you are going to have to pay. So by adding money, you don't create that tax liability. You don't trigger that event at that point. So it's another reason to do it. And of course, the other thing about rebalancing more generally, when you rebalance, it does cause you to reevaluate what you hold and why. Because if you look at something and it's doing dismally, then you are likely to reevaluate that and actually say, do I even want it? And I'm thinking about the whole Woodford saga here. If people had rebalanced and reviewed at the same time, then they would less likely have been caught up in that whole scandal. So there you go. That's it for rebalancing. But a couple of points in there I think that probably a lot of people won't have realised in a slightly different way to look at it.
So that's it. We're done this week. Some really good pieces on investing. And I actually realised that you've given people 2 reasons to sign up for 80/20 Investor there.
That wasn't the intention.
I'm listening to that and I'm thinking already, I want to read that piece about which are the best ethical funds at the moment, and also the tool that you mentioned to be able to actually see where you're invested, see the bigger picture. I thought that was really cool. So yeah, good stuff. That's it. We're done for this week. Do remember, please do review the podcast. We've had lots and lots of reviews. We try and read out reviews every other pod or so, and we will definitely get back to that. If you head over to wherever you download your pod and leave a review and send us a screenshot of that, send it to Lauren at moneytothemasses.com. It's almost certainly going to be mug worthy, and we'll send you out a Money to the Masses mug.
And something I probably should have said at the beginning of the podcast is quite exciting. In the next couple of weeks, we are almost certainly now finalising an event we're going to do online live. It would have been perhaps the second live event we would have done in person, but because of the coronavirus, we can't do live events.
Frustratingly, we did one in London last year, and we had really good plans of maybe taking it up north or the Midlands, it's such a shame.
And we investigated that and we looked into it, but of course that all had to be pulled in the end. But now this event is going to be about property, and it's going to be about everything to do with property. The people who we're going to have on a panel, it's likely to be me hosting the event. People on the panel that we're going to be talking to will be likely from the mortgage background, a broker, lender, someone from the property market. So what we wanted to do is give people the opportunity to ask anything about the property market, because the property market has been hit hard by the coronavirus. And I don't just mean in terms of house prices, I mean in terms of how it's functioning, in terms of the lending criteria that's going on, deals being pulled, being added, stamp duty, holidays, surge of interest, people viewing homes, all this stuff. We want to allow you to ask any question. And I mean, do send in your questions. Email lauren@moneytothemasses.com with any questions you've got, and we can ask them to our panel, and we'll give you more details nearer the time.
And if you want to get in touch with Damien on anything else, it's Damien@moneytothemasses.com. Twitter, it's @moneytothemasses with a number 2. And I think we're pretty much done for this week. And I have to say, Damien, this is the first ever podcast we've done standing up.
I know. We've done
Did you like it? I liked it.
I did. We've done the whole show standing up. In the new studio, we've got desks that we can lift up and down. I would press the button, but the mic's on it, so it would have a whirring sound. But it means we're standing up. So if you felt that Andy and I were particularly energised this week, now you know.
So that's it. We're done for this week. Until next time.